As I mentioned in the last segment, we're going to get into, I'm going to just talk a little bit about a market update on what's been happening, just so our listeners understand where markets are, but how we can use these to all together, whether they're correlated or uncorrelated. The S&P 500 had a pretty, I guess, indecision was the word, I guess, for this past week. It went up right away, went down, and it looks like, at the time we're doing this show, it's going to be probably positive for the week, but not much movement. The Nasdaq about the same thing. Looks like it's been quite, I guess, sideways for the past 2 weeks. The Dow is about the same as the Nasdaq. It's been kind of sideways for the last couple of weeks, but that still has opportunities within there on shorter term time frames. A lot of people like to use the United States dollar as a benchmark on their investment decisions, and that's been basically since 1914 or so crashing, we'll say,
Right.
losing value.
Mm-hmm.
But in the past 4 weeks, it's also been dropping. That's sitting at about $90 right now for the United States dollar. A lot of people like to utilize the oil market. I mean, think of airlines; they're hedging their jet fuel. I mean, we drive every single day. I think people are seeing the price at the pump a little bit higher. At the time of this show, it's about 64, 66. So that's been continuing to rise really since this past May of 2020. Now, a lot of people like to utilize the interest rates on their decisions as well. That's kind of impacting inflation, all that stuff. How companies can borrow? Are they growing, or what are they doing? So like the 10-year yield right now is sitting at about $1.65. Okay, with that, people use the 10-year futures contract as a inverse correlation in their decisions as well. That's at about 131.26. So I just gave up a bunch of different updates on what's happening in these markets. But the fact of the matter, Al, is you can use these in your investment decisions all together if you'd like.
Right.
Understanding how the dollar works, how that impacts oil, how that impacts the stock market. Dive into that a little bit more and why all these markets really gel together.
Well, yeah, you mentioned a lot of things, and I'm sure people are going, "What, do I have to know all those things?" No, you don't. But what we find is that you can identify maybe a couple of them that will help to confirm your decisions. We want to use to get that confirmation. Let's just say that the stock market is moving up. There may be other assets. There are other assets that typically go the opposite direction. So you can use that. Look at gold, for example. If the S&P is going up, typically gold will be going down. If you see that happening, that's going to give you confirmation that maybe the S&P will continue to go up. What if gold's going up and the S&P are going up? Well, there's something maybe wrong there. One of those two will probably change.
Why are they inversely correlated typically?
Well, because the impact of the stock market, for example, can have an impact on a commodity or on gold, for example. There's those inverse relationships because people will go from what they consider to be maybe a riskier investment into a safe haven investment.
Got it. Okay.
And you have the ability to do that. In fact, you should learn how to do that because that gives you the opportunity to increase your rate of return. And think about it, when the market is going in the direction that you want it to go, or whatever the investment is that you're in, you want to make sure that you improve the results. You maximize the results of those if you can. A lot of people have been counting on the stock market and probably are thinking it's just going to continue to go up. The Fed's going to keep pumping money into it. But Goldman Sachs recently, now maybe they've changed this was a few days ago, but their forecast, year-end forecast for the S&P 500 was 4,300. Well, the S&P is around 4,200 right now, which means that we could be looking at maybe a 2% increase by the end of the year.
Whoop-de-doo.
Are you going to be happy with that?
What's inflation do? That just lowers your return just based off of inflation.
That pretty well wipes it out.
You were talking about fees earlier. So if that happens, say there's, like Al was talking about, if there's a 2% increase in the market, this is based off Goldman Sachs,
Goldman
right?
Sachs. Mm-hmm.
Let's just say that does happen. There's inflation, they like to call around 2%. So that just lowers your return right there for those buy and hold people, but also the fees. So
Right.
that's really not a very good opportunity. So it's great to understand these other assets and utilize those.
Yeah, I think that if you want to try to kind of mimic what you've achieved in the last couple of years in the market, you're probably going to have to do something different. You may have to be more selective about what you do. Again, that's why it's so important to be able to follow what these companies are going to be doing. And understand that some of the investments will be up, some of the investments will be down. And the important thing is to make sure that if you have an investment or a trade that is going against you, that you minimize the damage that can be done. That's part of a risk management strategy everybody should follow. It should be part of a plan that you put together. And no matter what you're trading or investing, always, first of all, look at the risk and learn how to control it. That's something that can be managed. But if you can do that and maybe utilize some of these assets that have leverage might be what will give you the opportunity to increase the returns over what Goldman Sachs is saying that the S&P is going to provide. I mean, nothing is guaranteed, but if you don't have knowledge about the assets that might be able to provide greater rate of returns, then you're simply going to have to accept those kind of mediocre returns that we may be facing.
Yeah, and that's the fact of the matter is we never know which way this market goes. But if you have techniques and if you have strategies for any market condition, do you really care which way this market goes?
You shouldn't care.
You shouldn't care. And that's what a proper trading and investment plan will do, is help you make those decisions without an opinion or a care in what this market does. If you want to learn more about that, Al teaches investing classes on how to do that, how to utilize multiple markets to make better investing decisions, but just to do that with more confidence. So callers 1 through 10, I want to invite you to an investing class that he teaches here in Bloomington. They're only 2 hours, so let's go with callers 1 through 10, one for you and one for a friend. Call 952-814-4410. That's 952-814-4410. Al, we've talked about many different markets, many different assets, how to utilize them, different techniques and strategies, but people still don't really know how to get started. Mm-hmm. What do you think is you've worked with thousands of people with your time here. What do you think is some of the first steps to get started, but to do that with more comfort?
Well, if you want to go anywhere, you want to move, you have to take a first step. One foot's got to go forward first to get you in motion. And that's really what we're kind of emphasizing in these classes right now is learn to take the first step. What is the first step? And maybe before you even get to that point, learn whether this is something that is right for you or not. Investing and trading might not be right for you. You may be better off looking at something else, maybe having somebody do this for you. But for those of you that want to try to take more control over what you have, why not just learn whether this is something that is going to work for you, is going to be right for you? There's all sorts of sources of education material. You can go to the library, you can go to Barnes and Noble, you can look at YouTube. But remember, that's just basic kind of lectures mostly, or just reading things, or maybe listening to a CD. What the real learning comes when you have what we call kind of an experiential education source. That's where you are actually hands-on trading with somebody that is kind of guiding you and watching you. But again, let's make sure first that this is something that is going to be right for you, that you feel comfortable with, and that you feel that you have the right location to get the proper education that is going to be needed.
I'm glad you brought that up. You just kind of made me chuckle a little bit. You were mentioning books at Barnes and Noble and all the different sources that are out there for that people like to get their education or their knowledge from. Mm-hmm. The one you mentioned was YouTube. Yeah. Mm-hmm. We see a lot of people come to these investing classes and they say, "Yeah, I've been watching a lot of YouTube videos." Think about this now. Do you want to put your hard-earned money into something and you learned how to do that potentially from a guy that's living in his mom's basement? Because that's where a lot of that knowledge is coming from on YouTube. You don't know who it's from, what they've done, how they've done it. Online Trading Academy, our sponsor, has been teaching people the skills of trading and investing for over 23 years. And a lot of their instructors have came from the floors of the exchange. Their students are now learning how to trade and invest, but they're also getting into teaching people as well. It's that less reciprocity. Once you learn how to do it, help others as well.
Right.
So if you want to learn from people that have done it before, if you want to learn from trained instructors as far as how to teach the material, how to teach how the financial markets really work. Al, hit them up with some words of wisdom.
Well, just more encouragement. I want to encourage you to do something now. The years go by faster than you think. If you don't think they do, just ask somebody that's 70 or 80 how fast the last 70 or 80 years went by. And then listen to them tell you that what they regret most is not the things that they did, it's the things that they didn't do. These markets are providing opportunities on a regular basis, but every opportunity that's gone is one that's gone forever. You'll never get that back. But if there are assets and strategies that can improve your odds of success and then be able to provide the ability or the potential to do that in up, down, or sideways markets, why would you want to miss out on that?
And do it today. Same time, same place. Until next week, retire young, my friends.